Mr. Abhinav. Mr. Abhinav acquired 10,000 unlisted equity shares, 10,000 unlisted equity shares of A Private Limited, on 12th of December 2000. On 12th of December 2000 for rupees 80 per share. For rupees 80 per share. Full stop. Brokerage paid at the time of purchase. Brokerage paid at the time of purchase was at the rate of 1%. Was at the rate of 1%. Full stop. He was also allotted bonus shares. He was also allotted bonus shares on 30th March 2001. On 30th March 2001. In the ratio of 1:1. In the ratio of 1:1. Full stop. Give a paragraph. Write down the FMV of these shares. The FMV of these shares as on 1st April 2001 was rupees 120 per share. Rupees 120 per share. Again, paragraph. Additionally, he was allotted 5,000 bonus shares. He was allotted 5,000 bonus shares on 18th August 2023. 18th August 2023. Full stop. He sold all the above 25,000 shares. He sold all the above 25,000 shares for rupees 450 per share. For rupees 450 per share on. Now what you will write? After writing on, you will write two dates. A, first date, A, 18th April 2024. Or B, 21st of November 2024. Full stop. Brokerage paid at the time of sale of these shares. Brokerage paid at the time of sale of these shares was at the rate of 1.5%. Full stop. Compute the amount of capital gain chargeable to tax in the hands of what was the name of the assessee? Mr. Anirudh Abhinav. In the hands of Mr. Abhinav. Full stop. Did you write? Now, did you understand the question? We are supposed to solve this question now. Now pay attention, please everyone. Pay attention. This question is framed by me in order to test that whether whatever we have learned, how much we have understood. Okay. See, if I talk about the solution, okay, let us first assume, don't write anything. Don't write anything. Let us first assume that the shares are transferred on 18th of April 2024. 18th April is the date of transfer. So now you are having three, lots of the shares. You are not having all these 25,000 shares. You are not acquiring them together. 10,000 shares you are buying. Then again the another 10,000 shares you are receiving as what? As bonus shares. Then again once more you are buying. Once more 5,000 shares are received by you as what? Bonus shares. See, in all these three cases now, we have three lots. All the three lots are acquired at different time, at different cost. So their period of holding will be different. Because if I say the first 10,000 shares were acquired by you on 12th of December, meaning 2001. Okay. 12th of December, you acquired the shares. What was the cost of these shares for you? Come on, tell me. What was the cost of these shares? You acquired per share at 80 rupees. And at the time of acquisition, you gave 1% brokerage also. So 80 into 10,000 will give you 8 lakh. 80 into 10,000 will give you 8 lakh rupees. Plus 1% brokerage also you paid at that time on the selling price. So your actual cost of these shares was 8,08,000. Correct? No? Now wait. Did you acquire these shares on 12th December 2000? Yes. Have you acquired it prior to 1st April 2001? So you will get an option to take the fair market value also as a cost. So what was the fair market value of these shares? 120 rupees per share. So 120 into 10,000, you will get 12 lakh rupees fair market value. No need to add any brokerage etc. in this. This fair market value takes care of everything. Yes or no? Add brokerage only in the purchase price, only to determine the actual cost. Okay. No need to add it in the fair market value. Fair market value takes care of everything. So 8,08,000 or 12 lakh, you get the option to take the fair market value also as a cost if the shares are acquired prior to 1st April 2001. So which one would you take as a cost? Definitely, sir, 12 lakh you will take the cost. Did you get the cost of these shares? Now, these shares you are transferring on what date? 18th of April 2024. Along with 25,000 shares, these shares are also going. 18th April. So date of transfer is 18th April. So from here till here, will you get the period of holding of the shares? Now tell me, the shares are transferred on or after 23rd July 2024 or they are transferred prior to 23rd July? Prior to 23rd July. Meaning that these are unlisted shares which are transferred prior to 23rd July. That time we used to check the period of holding as 24 months only. So is the period of holding more than 24 months? Yes. Then these shares are having the shares, this lot has the shares, all the 10,000 shares are what? Long-term capital asset, held for a period of more than 24 months. And the cost also you came to know that this is the cost. Now will you index the cost? Yes or no? Now how that indexation takes place, that I have to tell you now. Okay, how the indexation takes place, that I will tell you, don't worry. But have you calculated so far? Okay, now pay attention. Now we will talk about 10,000 bonus shares. Why 10,000 bonus shares? You got the bonus shares in the ratio of 1:1, meaning that the date on which you got the bonus shares, on that date you were already the owner of how many shares? 10,000 shares. Now if you are the owner of 10,000 shares, you will get 10,000 more shares as what? Bonus, 1:1. So this you got on 30th March 2001. Same previous year, but on 30th March 2001. Meaning that these bonus shares were acquired prior to 1st April 2001. Prior to 1st April 2001, you acquired these bonus shares. So for these bonus shares also, their cost of acquisition will be either the actual cost or the fair market value, whichever is higher. So what was their actual cost? Bonus shares costed you nothing. Actual cost was nil. And the fair market value of these shares of A Private Limited was 120 only, no? At the time of 1st April 2001. Yes or no? So 120 I will take here also. Into 10,000 bonus shares. I will get 12 lakh rupees fair market value. So nil or 12 lakh, whichever is higher, 12 lakh will be the cost of acquisition. I will not take nil. Definitely, why would I take nil if I am getting the opportunity to take 12 lakh as cost? Since the bonus shares were acquired prior to 1st April 2001, their cost of acquisition will be either their actual cost, which is nil, or the fair market value on 1st April 2001. Everyone. So I will take 12 lakh as cost. Now, these bonus shares were acquired on this date, transferred on 18th April along with 25,000 shares. These 10,000 shares were also sold. 18th April. So their period of holding is from this date to this date. Is it more than 24 months? Yes. Why are you checking 24 months? You know the logic now. They are transferred prior to 23rd July and they are unlisted bonus shares. Hence we are checking 24 months. Okay. Now if this is more than 24 months, then whatever cost you have determined needs to be indexed also. Indexation you will get in the cost of acquisition. Yes or no? Now you have 5,000 bonus shares also. These 5,000 bonus shares were issued to you on 18th of August 2023. And these 5,000 shares also you sold on 18th of April. So all the shares are sold on the same date. Can you see? But the date of acquisition is different. Now check. For the last 5,000 bonus shares, your period of holding is not more than 24 months. It is less than 24 months. From 18th August 2024 to 18th April 2024. Hardly 5-6 months. 6-7 months. Yes or no? So is the period of holding more than 24 months or less than equal to 24 months? Less than equal to 24 months. This 5,000 shares, bonus shares, the lot, this entire lot and all the shares in this lot will be treated as short-term capital asset as of now. As on 18th of April. Now what will be the cost of acquisition of these shares? Are the bonus shares acquired prior to 1st April 2001? Or on or after 1st April 2001? On or after 1st April 2001? So what will be the cost of acquisition? Their actual cost, which is nothing but nil. And here you are not going to get that option to take fair market value. Yes or no? So it's finally, its cost of acquisition will be nil only. Did you identify the cost for all the shares? Sure. Now pay attention. You have to now index them. Index the cost. Why? Since all the shares were transferred prior to 23rd of July. Now what is indexation? First of all, understand. I will write down one formula. See, before writing down that formula, I would like to tell you that indexation is a benefit. Indexation is a benefit because of which the cost is inflated, cost is increased. Now, if you go to your ICAI study mat, in your ICAI study mat, no, there is one indexation table which is given. Wait, I'll tell you. It is on what page? It is on page number 3.394. Can you see this table is given over there? Okay. Now what is this table? Come on. Please check what is the first year you can see over here. 2001 and 2. Okay. And what is the cost inflation index written in front of that? 100. So 2001-2 is kept as a base year. 2001-2 is kept as a base year. See, when we were students now, in our time, our base year was different. In our times, it was 81-82. Yes, it was 81-82. But right now, the government has changed. Since many years, this has been changed. Okay. But the base year is changed to 2001, 2002. Now, if you consider base year 2001 and 2, the CII taken is 100. Meaning that if anything whose cost was 100 in 2001 and 2, this is the base year, and now inflation will be checked. Considering this as a base year, now the inflation will be checked. That same thing, the cost of the same thing became 105 in the next year. It became 5 rupees more costlier. That same thing, the cost of that thing became 109 in next to next year. Then it became 113. Then it became 117. Then it became 122. Likewise, see, the cost is increasing. The cost is increasing. And right now in 24-25, the same thing costs how much? 363. Almost 3.5 times more as compared to 2001-2. So that time, if something costed me 100 rupees, no, some asset, the cost of that asset was 100, no. Right now, today, the cost of that asset is 3.63 times more. That same thing will cost me 363 right now. What is the reason for that? Reason is inflation. And that inflation is counted here. This is an index showing your cost inflation. Hence, this index is known as cost inflation index. In reality, it is more. Okay. So, the government has prescribed this much only for capital gains calculation, sir. Okay. So, you are going and telling the government, in reality it is more. So, for you, we will not make a new income tax law, no, macha? Income tax law is made common for everyone. Okay. Everyone is following this according to us. This is the inflation. In reality, it is too much, we know. Sure. Now pay attention. Something which you acquired in 2001-2 is now worth 363. Now pay attention. I will give you one example. Okay. What is that example? If one capital asset I acquired, any capital asset, if I acquired in 2009-10, so the year in which I acquired was 2009-10, and at that time I acquired it for 4 lakh rupees. What was the CII in the year 9-10? Come on, let's check. CII in the year 9-10. Can you see? In the year 9-10, it was 148. So at that time, the CII was 148 in the year 9-10. Okay. So when CII was 148, that time I had incurred a cost of rupees 4 lakhs. Now the same asset which I acquired in 9-10, I am selling in 2024-25. So the capital asset which I acquired in 2009-10 is now being transferred in 24-25 when the CII is 363. So what should have been the cost of this asset today? Cross multiplication. As simple as that. Can you do it? So I will do 4 lakh into 363 divided by 148. I will get 9,81,081. 9,81,081. 0.81 will be my cost. Meaning that if I go and buy this same asset today, I will get it for a cost of rupees 9,81,081. The asset which was costing 4 lakhs in 2009-10, its cost has come up. Its cost has increased to how much? 9,81,081 today. Now, if any asset which is a long-term capital asset, if any asset which is a long-term capital asset, over a period of time, there is an inflation in its cost. Some assets, you will see the inflation in their cost after 12 months. Some assets, you will see inflation in their cost immediately after 24 months. Some assets, you will see the inflation in their cost after 36 months. Real inflation starts in their cost. Hence, the period of holding is 12, 24 and 36 months for different types of assets. Getting my point? So, whenever you acquire certain assets and you hold it for 12 months, those 4 assets, usually the inflation starts showing its effect on those assets after 12 months. Within 12 months it is okay, but after 12 months inflation starts showing effect. Those 2 assets, unlisted shares, immobile property, within 24 months, after 24 months, the inflation starts showing their effect. So whenever these assets are held for more than 12 months, inflation will start showing effect. We will be giving the inflation effect also. We will allow you to take the effect of inflation also in the cost. Take it. Inflate the cost. All other assets, the inflation affects their cost after 36 months. So hold them for more than 36 months. They will become long term. We will allow you to inflate their cost. We will allow you to index their cost. We will allow you to take the inflation as a factor to be included in your cost. Yes or no? Now that 36 months is no more in existence also, and for all the assets, the indexation is also taken away. But now see, if in the 2024-25, you transfer the asset for rupees 10 lakhs, why someone was ready to give you 10 lakh for that share, for that capital asset? If you acquired that asset in 2009-10 for 4 lakhs, no. So why someone was ready to give 10 lakh rupees for that asset today? Because of the inflation. The cost would have increased. And as a result of that increased cost, you are getting a higher selling price today. So if you reduce that cost which you incurred long back from this selling price, you will not get correct profit and gain. If you want to have correct profit and gain, both the amounts should be comparable. No, selling price is in today's terms. After considering inflation and everything, the cost would have increased. Hence, you are getting this much selling price. So, bring your cost also to today's level. Bring your cost also to today's level by inflating your cost. So, when you bring both the figures at today's level, only then it is going to give you correct profit and gains. Getting my point, everyone? So what will happen now? From 10 lakhs, instead of reducing the cost of 4 lakhs, now reduce the cost of 9,81,081. So you will not be given the deduction of 4 lakh, you will be given the deduction of 9,81,081. Tell me how much? It will be 189, 18,919. Just imagine your capital gain is only 18,919. If no indexation was given, it would have been 6 lakhs. And now they have done that only. But if you transfer the asset on or after 23rd July 24, now there will be no indexation, and what will happen? Whatever cost you incurred, that cost you reduce. Now just imagine, on this if 20% was applied, after taking indexation, your whatever capital gain was there, no, on that long-term capital gain, the rate of tax was 20%. So your tax would have been 3784. 3784 only. The tax would have been only 3784. Are you all getting this tax? Now just imagine if the indexation is not given. So we'll take the same selling price, 10 lakhs. Out of that you will now reduce 4 lakh rupees cost, friends. And your capital gain will be 6 lakh. Madam Nirmala Sitharaman saying, see, we have taken away indexation from you, no? So your government is thinking too much about you. Don't worry. Your capital gain will be higher, no? So we'll compensate by giving a relaxation in the tax rate. Now your tax rate on the same long-term capital gain will be 12.5%. Apply 12.5%. 6 lakh into 12.5% will give you, still 75,000 tax. Just see the amount of tax which they are snatching from your pocket. And now this, see, because of the indexation, no, sometimes the assessee used to calculate the loss also. Sometimes no, majority of the times the assessee used to calculate the loss also. Now there are no chances that he will get a loss. Very rare chances he will get a loss. Even if a small portion is considered as profit, on that we are getting 12.5%. In 100 transactions, only in 10 transactions the gain was happening, and then that gain was also not too much. On that we were charging 20%, this much high tax, and we were getting peanuts as what? Tax. Now in all the 100 transaction, majority of the transaction, almost 95% transaction, profit will be there. And that profit will not be a small profit, it will be huge profits. And on that, even if we charge 2 to 5% tax, no, still we are able to collect a huge amount of taxes. But see, still they have started charging 12.5%. How smart our government is. This is the way in which the indexation is done. Will you be able to do it? Now wait, please pay attention here. This happens. What you have done? You have taken the cost of acquisition. You have multiplied by the transfer year CII. And then you divide by the acquisition year CII. You got this amount. So can you derive a formula? Cost of acquisition multiplied by CII of transfer year divided by CII of acquisition year. You will get index cost of acquisition. That formula is nothing but a simple cross multiplication. Yes or no? Now if I change this example a little bit, you will go mad. See, if that same capital asset was acquired in 94.95, instead of 910, it was acquired in 94.95. For how much? 4 lakhs. And that is transferred in 2024-25. Yes or no? CII for the transfer year you will get 363. But CII for acquisition year will be missing. Because if you will see the CII table, no, it starts from 2001-2 only. So Kaushik, if you have acquired the asset in 93-94, do we make a new CII table for you? Somebody would have bought the asset in 76-77. For them, do we prepare a new CII table? Different assessees would have acquired the asset prior to 1st April 2001 at different dates. So, do we have to prepare CII table for every year? No. The CII table will be common, having a common base year of 2001-2. Now, you have to see that when you acquired, did you acquire prior to 1st April 2001? Yes or no? When did you acquire? In our example, you acquired in 94-95. So, see, 94-95, when you acquired the asset, what was the cost of that asset at that time? 4 lakhs. Yes or no? Now, in the year 2024-25, you are selling the asset. That asset you are selling for 10 lakh right now. Hello, sir. But before that, there will be a date. Date will be 1st of April 2001. 1st April 2001, on this date, we will take the fair market value. The fair market value as on this date. For example, the fair market value was 4,60,000. Possible or not? In the year 94-95, you bought for 4 lakh. Now there is a characteristic of the asset. Hello. Whenever you invest in a capital asset, no, the value of the capital asset slowly and gradually keeps on increasing. Yes or no? So 93, 94 you bought. By the time 2001-2 will come, its fair market value, its market value will increase. And it will increase to 4 lakh 60. Example. It can be any amount. It can be 5 lakh also. It can be 6 lakh also. It can be any amount. But in our example, we are taking 4 lakh 60. 55 subsection 2 clause B is giving you an option. What option? If you want, you can take this fair market value also as cost of acquisition. Why that option is given, you know? We cannot issue a new CII table for everyone. Because everyone, not necessarily that everyone would have acquired the asset in the same year, on the same date. There can be multiple, dates of acquisition. Very old assets can be there. Some asset can be acquired in 1960s. Some asset can be acquired in 1970s. Yes or no? Few of them will be acquired in 90s. Some assets in 80s. Maybe even prior to that also. We never know at what time you might have acquired the asset. Yes or no? But we have to keep one base year. That base year is fixed. April 2001 and 2 onwards. If that base year is fixed, then do one thing, no. Give the option to take the fair market value as at the beginning of that base year. What was the fair market value as at the beginning of that base year, as on 1st April 2001? It is 4 lakh 60. If we are giving you the opportunity to take this fair market value as cost, definitely you are going to take this fair market value as your cost of acquisition, because it will be higher only. Hello? And in majority of the assets, it will be higher only. 99% cases, it will be higher only. And if we are giving you this option, you will definitely take this as a cost. Now tell me, don't you think any inflation which affected from 94-95 till 1st April 2001 is already taken care of in that fair market value? Now no need to give you separately indexation, or no need to include inflation in your cost separately from 4 lakh onwards. Now what we are going to do, we are going to index, we are going to inflate this 4 lakhs till 24-25, because now we have CII from 1, 2 and onwards. Getting my point? Hello sir. So now what will you take here? Will you take cost or fair market value? Definitely you are not going to take cost. You are going to take fair market value 4 lakh 60 as on 1st April 2001. And now if you have taken it, do you have a CII? Yes. From here you have 100. So now do one thing. 460 into 363 divided by 100. Now you will get the index cost of acquisition. Do it. 1669,800. 1669,800. And see, you have transferred that asset for only 10 lakhs. Will it be a gain or loss? Now there will be a loss of 6,69,800. Long-term loss. What it, sir? Out of the selling price of 10 lakhs, you will be allowed the cost 4 lakh 60. No, 4 lakh 60 indexed. So the inflation from year of acquisition till 2001-2 also considered, fair market value given. Hello sir. And from fair market value onwards, meaning from 1st April 2001 onwards till 24-25, till that inflation is already considered. Now after considering the entire inflation starting from the year of acquisition till today, your cost will be 1669,800. Now that asset someone is buying from you for 10 lakh. Are you getting a gain or a loss? You are getting a loss of rupees 6,69,800. Now just imagine, if you are selling the same asset on or after 23rd July 2024, will you get index cost of acquisition? No. you will get only cost of acquisition 4,60,000, and in that case you will have 5,40,000 of long-term gain. Just imagine, you were not supposed to pay a single rupee of tax because you were having a loss. Now because of the indexation taken away, what is happening? What is happening, guys? You are going to pay tax on 5,40,000. 10 lakh minus 4,60,000, and that too also 12.5%. How smart the government is. So if I say formula, cost of acquisition, index cost of acquisition, you will take cost of acquisition, you will multiply CII of transfer year, and you will divide what? You will divide CII of acquisition year. But wait. If the acquisition year is prior to 1st April 2001, then for that year CII will not be available. Then in that case you will have to take the fair market value. Option will be given to take the fair market value, and you will divide the CII of 2001 too. If you acquired the asset on or after 1st April 2001, then only the acquisition year CII can be taken. So here now what we are going to do, CII of acquisition year or 2001 to whichever is later. So if the acquisition year was 94-95, so take 94-95 or 1-2, whichever is later, 1-2, divide the CII of 1-2, because you must have already taken fair market value by then. Hello sir. If the acquisition year was 9-10, so 9-10 or 1-2, take the CII of 9-10, because 9-10 is later than 1-2. Sure sir. Hello sir. This is the way in which the cost of acquisition must be indexed. Now coming to our question. Now tell me, these shares are acquired in 2001 to 2001, prior to 1st April 2001, yes or no? Prior to 1st April 2001, and you have taken the fair market value also as a cost. Hello sir. Now will you do the indexation? Yes. But to do that indexation, you now have cost multiplied by transfer year CII 363 divided by CII of which year? CII of 2001-2, because the acquisition was happening prior to 1st April 2001. Yes or no? So you will be taking the CII of acquisition year 2000-2001, not available sir. So take the CII of 1-2, because you are taking the fair market value as cost. Getting my point, everyone? So what will be the cost of acquisition? 12 lakh into CII of transfer year. 12 lakh is your cost of acquisition, multiplied by CII of transfer year divided by CII of acquisition year or 1-2, whichever is later. Acquisition year was earlier, 1-2 is later, so divide the CII of 1-2. Here also you will do the same thing. So 12 lakh into 363 divide by 100, 43,56,000. In both the cases you are going to get what? You are going to get index cost of acquisition. Now see, for these 5,000 shares, no, they are short-term capital asset. Whatever actual cost is there will become the cost of acquisition also. You will not get any fair market value. You will not get the option to take fair market value as cost, because these bonus shares were acquired on or after 1st April 2001. So for them, their actual cost only will be taken as what? Cost of acquisition, which was nothing but nil. And see, you are calculating short-term gain, no need to index also. And nil, if you index also, will remain nil only, no? First of all, nil cannot be indexed. After indexation, it will be nil only. And second, there is no need to index also. Why? Because the asset is short-term. In short-term capital asset, cost is never indexed. Yes or no? So what will be the cost? Nil. Without indexation, you will reduce. Now, we are going to do the calculations. Come on. All the lots, separate assets. 10,000 shares, 5,000 shares. What is the full value of consideration? In the bracket only we are writing sale proceeds. Always have the habit to write in the bracket that what amount you are taking as full value of consideration. Because sometimes no, you will have to take specific amount as per specific section to be taken as what? FVC. So what amount you have taken here as FVC, if you show that in the bracket only, you don't have to write down a note separately for that. Getting my point? So in this case, we are taking the sale price only as what? Cost of acquisition. So sale price was 450 per share, 450 per share, 450 per share multiplied by number of shares. So we are getting 45 lakhs and 22 lakh 50,000 as full value of consideration. At the time of transfer, at the time of sale, are we paying any brokerage? Yes, we are paying 1.5% brokerage. So 1.5% of selling price, 1.5% of selling price, 1.5% of selling price. You will get 67,500, 67,500 and 33,750. This is your transfer expense. Any brokerage paid at the time of transfer by the transferor is his transfer expense will be reduced as a deduction. Now you will get the net consideration. Are you all getting it? What is happening? Plus minus you are supposed to do, simple. Now out of this, will you reduce cost or index cost? Everywhere index cost. First two cases index cost, last case cost only. Index cost what we have calculated, no? See, the same amount we are going to write here in the calculation. 4356, 4356 and nil. Here your capital gain will be 7600, 7600. This is your taxable long-term capital gain. Taxable long-term capital gain. And this is your taxable long-term short-term capital gain. Here the entire amount of net consideration will become your gain because there is no cost only. Getting my point? Did you copy this? Copy fast. Copy this fast. Done. Done. Now give the next heading. If all the above shares are sold, if all the above shares are sold on 21st November 2024, then capital gains will be computed in the following manner. Then capital gain will be computed in the following manner. Pay attention now. When the shares are sold on 21st November 2024, what will happen? Is the transfer happening on or after 23rd July 2024? Yes or no? So the cost and everything remains same. But the only difference will be indexation benefit will not be available. Meaning that in the first and second case, what was the cost of acquisition which we determined? 12 lakhs, no? And the last case nil. All of them will remain same. But without any indexation they will be reduced. Now your cost of acquisition is reduced and see how much capital gain is coming. Now your long-term capital gain will be 64,65,000 in first two cases taken together. And last one remaining same, 22,16,250. So copy this part first. Write down note below this solution only. That note is relevant for this solution. Okay. In the above solution, write down in the above solution, even if the 10,000 acquired shares and 10,000 bonus shares are long-term capital asset, their cost of acquisition is not indexed since such shares are transferred on 21st November 2024, that is 21st November 2024, that is on or after 23rd July 2024, on or after 23rd July 2024, full stop. This is the note applicable only for this solution. Okay. Now what you will do, you will keep some lines blank to make this working note again, that you are going to do on your own now. Okay. But in this working note, what will change? See, this will remain same, but only the date of transfer you will change now. Date of transfer, instead of 18th of April, what will come? 21st November 2024. Yes or no, sir? You will change this only. Period of holding, this will remain same. No need to change. Cost of acquisition calculation will remain same. Till here everything will remain same. Only the date of transfer you are going to change. Yes or no? And don't write this. No need to do any indexation. That's it. And that we have not done. So below that note, you are going to make this same to same working note. That is your homework for today. Will you be able to do it? Everyone, now pay attention. One note, another note I am giving you. See, in this question which we have solved now, it tested almost all the concepts which we have studied so far in the chapter. Yes or no? Now, if in this question they have told you that 10,000 shares acquired, 10,000 shares bonus, again 5,000 shares bonus. So, how many shares you had? 25,000 shares. And the question told you that, sir, madam, all the above shares are sold. The question could have told you that out of all the above shares, 22,000 shares are sold. How many shares are sold? Then which 22? 10, 10 and 2,000 out of last, or second 10,000, then 5,000 and then 7,000 from the first 10,000. It can be in any permutation combination, sir. No. Always follow FIFO basis. What? Always follow FIFO basis. Meaning that the shares which you are acquiring first, in the first lot. See, same company shares, you can have multiple shares. Different company shares are different capital asset. Yes or no? But if for the same company, different lots are bought, every lot will be considered as a separate capital asset. Every lot will be considered as a separate capital asset, and for every lot, there will be different period of holding, different cost and everything. Yes or no? But in that case, it is not necessary that the shares, the total shares which you are having for a same company, but you acquired those shares in different lots, it is not necessary that you are going to sell all of them together. What if you are selling some part of the shares out of the total number of shares? What will happen? That time you will have to follow FIFO basis, meaning that if they are telling you that you are selling 22,000 shares, then first 10,000 shares are sold, second 10,000 shares are sold, and the 2,000 shares, extra 2,000 shares are sold from the last lot. Last lot was 5,000 shares. Yes or no? Out of that 2,000 shares are sold. Now 3,000 shares which are remaining in your stock, no, that is from those 5,000 bonus shares. Whenever you will sell them in the future, their period of holding will be started from the date of acquisition of these shares, bonus shares. Yes or no? Cost of acquisition will be taken as nil because that 3,000 is remaining out of the last lot. Getting my point? So write down a note. If the shares of a same company, important note, this is important note. If the shares of a same company are acquired in different lots, then each lot will be considered as a separate capital asset. Each lot will be considered as a separate capital asset. And at the time of sale of these shares, FIFO basis to be adopted. FIFO basis to be adopted. First in, first out. To determine their period of holding and their cost of acquisition. Will you remember this? Full stop. This is the end of the note. This is important note you are supposed to remember. Okay, no? And test your knowledge. Come to question number 4. Mr. A is an individual carrying on a business. His stock and machinery in the business were damaged and destroyed in a fire accident which occurred in December 2024. The value of stock lost, total damage, was 6,50,000. Certain portion of the machinery could be salvaged. Even the machinery got damaged or destroyed, but certain portion could be salvaged. Okay. The opening balance of the block of that machinery as on 1st April 2024, that is WDV of the last year minus depreciation of the last year, closing WDV of last year becomes opening in this year. Okay, no? Is 10,80,000. Done, sir. Now, during the process of safeguarding machinery and the firefighting operations, Mr. A lost his gold chain also and a diamond ring, meaning jewelry is also lost in the firefighting accidents. Okay. Which he had purchased in April 2005 for 1,20,000. So this is the date of acquisition of jewelry and purchase cost of jewelry, actual cost of jewelry. The market value of these two items as on the date of fire accident was 1,80,000. Both taken together, the market value as on the fire accident date was 1,80,000. Now in this year, these assets are going damaged or destroyed due to fire. Hello? So whenever these assets will be damaged or destroyed due to fire, now fortunately you have taken the insurance for all these assets. So the insurance company is giving you, in this year only, you are getting the claim of rupees 4,80,000 towards that stock which is lost. 6 lakh rupees you are getting for the machinery and 1,80,000 you are getting for the jewelry. Fortunately, for jewelry, the insurance claim received and the fair market value is same. Can you see? Fortunately, this is same. If I would have been there, no, I would have given 1,80,000 over here and I would have given 1,50,000 over here. Then you would have been in a trouble. Right now also you are in trouble. What to do you are not understanding only. See the required part. You are requested to briefly comment on the tax treatment. That's it. What will be the tax treatment from all these things? You are supposed to become a chartered accountant and think. You are a chartered accountant. Your client is coming to you. Client is giving you this information. What suggestion you will give to your client? Forget about suggestion. You should know for your client what will happen for these amounts. If you will not know, then who will know? A doctor. You're a chartered accountant. As a CA, you should know na, that tax treatments. Come on. So, please pay attention. Wait. Damage or destruction of what? First item, stock. Okay, stock. What was the value of this stock? Come on, tell me. 6,50,000. Now the 6,50,000 is a loss happening in your business. The stock of the business amounting to 6,50,000 going, lost by fire. Is it a profit happening in the business or a loss happening in the business? So can I say this is a loss incurred in the course of business or profession? So the 6,50,000 is equal to loss in the course of business. And for the 6,50,000, no, you will get the deduction under the head PGBP. The deduction will be allowed because without adjusting this loss, your profit cannot be calculated. Under which section the deduction will be given? No section, common sense. I've told you. Hello, sir. So under the PGBP head, you will claim the deduction for this 6,50,000 loss. But the loss against which, the loss which was already allowed as a deduction, against which any benefit is happening, that benefit will be as per 41(1) deemed PGBP income. Do you remember? So this loss which was allowed, against this loss only you are getting that insurance claim. Benefit, no. So that insurance claim which you are receiving against this loss is a benefit happening against a loss for which you are claiming deduction. Hello, sir. So that 480 for that stock, 4,80,000 is equal to insurance claim. 480 insurance claim against the above stock. So this 480 will now be what? Deemed PGBP income under section 41(1). You don't know such treatments? I haven't taught you. PGBP head, if you remember, this is entire PGBP because business stock going loss for business claimed as a deduction. Against that, whatever benefit you are getting, deem PGBP. The same example also I gave while teaching you 41(1). But I did not tell you the amounts that time. If you remember those things, no, definitely you will be able to answer these things. Now, two. Second thing was machinery of the business. The machinery which was depreciable asset of the business. Even that machinery lost by fire. So machinery is lost during this year. Machinery is lost during this year. Meaning that there was some opening WDV of the machinery. Tell me yes or no. There was some opening WDV. As on 1st of April 2024. What was the opening? 10,80,000. Now tell me, the machinery which is lost by fire, damaged or destroyed by fire, that machinery would be from this machine only, no? Because there is no addition happening in this block in this year. Is there any addition for 180 days or more, less than 180 days? So there is no addition. So if I'll write add additions during previous year 24-25. So there are no additions per se. So your block should have some machine in the end whose value should have been 10,80,000. On that you would have claimed depreciation. But what happened? This year, out of the machinery which should have been there in your block, damaged or destroyed, asset is going out of the block. Hello, asset is going out of the block. Can it be sold and going out? Yes. Can it be compulsorily acquired and go out? Yes. Can it be damaged and destroyed and go out? Yes. So whenever the asset from the block is going out, from the business it is going out, it is to be going out of the block only, no? It is a deletion, my dear friends. So some machine which is damaged or destroyed is nothing but deletion. So what I will do, I will reduce deletion during previous year 24-25. This is damage or destruction. Now tell me, on damage or destruction, meaning on this deletion, whatever amount you will receive, can I say you are recovering that cost only? The cost of the block you are recovering, deletion, yes or no? So how much amount you have recovered? You have recovered 4 lakh, 4 lakh 80 or 4 lakh? How much you have recovered? 6 lakhs. Oh, 6 lakhs. So the recovery is 6 lakhs. See, whenever we create a block, no, additions happens in the block, deletion happens when the assets are sold, deletion happening. Assets are compulsorily acquired, deletion happening. Asset is scrapped, deletion happening. And even the damage or destruction, deletion happening, no? So against this deletion, are you getting anything? Yes. Insurance claim you are receiving, no? So to the extent of 10 lakh, to the extent of 6 lakh, out of 1080, 6 lakh you have recovered. Forget depreciation on this 6 lakh. Now you can claim depreciation on 4 lakh 80 only. Hello? Because out of 10 lakh 80, some machine gone. And against that you are recovering 6 lakhs. So if you are recovering 6 lakhs, meaning that 4 lakh 80 still remains. Now see, to represent this 480, there has to be some machine in the block in the end. Is there any machine in the block? They are saying that some portion of the machine was salvaged. That does not mean that is salvaged is still there in the business and getting used. Are they telling you? No. So there can be two interpretations of this. Some portion of the machinery can be salvaged, means It is still in the business and used. Or can be salvaged, it was salvaged but not usable, insurance company took away. There can be two interpretations. The best interpretation, I tell you, salvage machine still in the block and used in the business. If this is not mentioned, no, so we will assume that the salvage machinery was not, salvage portion of machinery was not usable only, and it was taken away by the insurance company. Hello. So loss assessor came and they took away the salvage machinery and they gave what? The insurance claim of 6 lakh. Now there is no machine left in the block, but still there is value remaining in the block. Can you see the value remaining in the block? How much? 480. So to represent this 480, is there any machinery in the block? No. So if there is no machinery, machine should be there, value should be there, only then the depreciation will come. Value is there, but the salvage machine is not there in the block. Because if nothing is mentioned, I will assume that the salvage machine is not used in the business. It was not usable. Getting my point? Hello? If this was the only machine in the block, it caught fire. 4 or 5 buttons could be salvaged. Portion of the machinery can be salvaged. Now tell me, will it be usable? Portion salvaged. Can it be used in the business? 4 or 5 buttons were saved. Definitely, if not saying anything, that means whatever portion which was remaining was not usable in the business. So the insurance company took away the salvage part, or it got scrapped. I threw it away. I don't have any machine in the block left now. So no machine left in the block, but the value remaining in the block, meaning that depreciation cannot be calculated. Depreciation under section 32 cannot be calculated now. Now what I will have to do? Come on, tell me. If I cannot calculate depreciation, that means this entire value remaining will now be treated as my short-term capital loss under section 5050. And I will write down it is assumed that salvaged portion of machine is not usable and discarded or taken away by insurance company. If I am taking this assumption, hence I am taking this no asset remaining in the block. If I would have assumed that the salvage machinery is usable, that means at the end of the year machine is there, value is also there, then I would have calculated the depreciation also. Getting my point? Mr. Kaushik, did you understand? Sure? Perfect. So this was the second asset, machinery. Okay. Now come to the third asset. What was the third asset? Jewelry. Gold chain and diamond ring. Can I say jewelry? Now for this also damaged or destroyed. meaning lost in firefighting operations. So friends, damage, destroyed, lost means transferred, and this asset means capital asset. Another capital asset is damage, destroyed. Here on this transfer, insurance claim is equal to 1,80,000 which is received, yes or no? And on receipt of this insurance claim, section 45 1A capital gain would arise. And now 45 1A capital gain will be calculated. So to calculate this capital gain, full value of consideration, what will you take? FVC, insurance claim under section 45 1A will be taken as full value of consideration, 1,80,000. Less transfer expense, no transfer expense involved. Net consideration will be 1,80,000 minus cost of acquisition or index cost, depends on the period of holding. So the jewelry, the period of holding of the jewelry I will take now. Period of holding will be from April 2005 or 2008, 2005 to December 2024. So it was acquired and it was lost. This is the period of holding which is greater than 24 months. So jewelry we used to check 36 months. If the transfer, if the damage would have taken place prior to 23rd July, we would have checked 36 months. But the transfer is taking place, damage or destruction is taking place on or after 23rd July. Hence we are taking 24 months. Yes or no? Therefore, long-term capital asset. And if it is a long-term capital asset, long-term capital gain will be calculated. To calculate the long-term capital gain, index cost of acquisition is usually reduced, but no indexation benefit will be available. Why? Why no indexation? Since damage, since lost on December 24, that is on or after 23rd July 24. So that is the reason why we are not taking indexation. Yes or no? So what will be the cost of acquisition? The cost of acquisition was 1,20,000 only, no? That will be reduced without any indexation benefit. So the balance 60,000 will now be taxable long-term capital gain. And this long-term capital gain is computed under section 45 1A. Will be taxable in which previous year? Previous year 24-25. This year. Why? Because the insurance claim is received in this year. See, this is the way in which I have presented the answer. I have discussed the tax implications only, but in such a way, no, that it appears very, interesting to see. Now, if you'll see read the answers given over there, no, go and read it once. You will come to know. It's a completely paragraph form, half of which you will not understand only what they have written. But ultimately, whatever written there, no, we have done that thing only. Understanding? So today at home, you will read that answer once. That's it. Entire thing is covered. They have not bloody calculated the capital gain also. We have calculated the capital gain also. This one. Illustration number 2. Illustration number 2. A is the owner of a car. On 1st of April 2024, he starts a business of purchase and sale of motor cars. He treats the above car as part of his stock in trade of his new business. He sells the same on 31st March 2025 and gets a profit of 1 lakh. Discuss the tax implication in the hands under the head capital gains. No tax implications would arise under the head capital gains. The entire profit of 1 lakh will be taxable under the head PGBP only. Why? Because conversion of capital asset into stock in trade will result capital gain under section 45(2). The asset transferred by him was a car, and if nothing is mentioned, I will assume that the car was a movable personal effect for him. And movable personal effect is not a capital asset. If you convert it into what? Stock. If you would have sold it, would there have been any capital gains? No. Why? Because that is not a capital asset only. So just because converting, there will be capital gain. Conversion of capital asset should happen into stock in trade. When you transfer capital asset, then capital gain arises. So when you convert a capital asset, then only 45(2) will arise, no? The transferred asset is not your capital asset only. Hence, on conversion, 45(2) will not be attracted. No capital gain will be resulting. Entire profit, 1 lakh, will be taxable under the head PGBP only. Out of this, something under capital gain, something under PGBP, that you are not supposed to do here. Will you remember? Everyone, easy question, difficult question, easy question. Okay, so this question is done. Question number 2 is done. Come to question number 1 now. Come to question number 1. Illustration number 1. See, illustration number 1 is about period of holding. Illustration number 1 is about period of holding. What will be the period of holding of the shares in the liquidation? See, write down. Discussed under section 46(2). So when I will be discussing 46(2) now, you will get the answer of this. Hello sir. What will be the period of holding of bonus shares? I have not told you. If the bonus shares are listed, the period of holding will start from date of credit in the demat. Hello. And it will end on date of sale. But if the bonus shares are unlisted, their period of holding will start from date of allotment till the date immediately preceding to date of transfer. Hello sir. So bonus shares already known, that you have done with section 55 to AA. Along with that, we have already done. What is a flat in a cooperative society? Do you remember we have done the definition of transfer 247? In 247, last transaction, I made a building, big building, many flats I made. The entire building owned by cooperative society. The entire land on which the building stands is also owned by a cooperative society. So, in that cooperative society, if you are owning a flat, are you the owner of that flat? No, you are not the owner of that flat. You enjoy the right. You have the right to enjoy the flat as an owner, which is because of the membership in that society. Hello sir. So once you become the member in that society, only then you enjoy the property as an owner, ownership right. Hello sir. Whenever you transfer that right, whenever you get that membership from the cooperative society, whenever the shares are given by the cooperative society to you, from that day you get the ownership of that flat. Till what time? Till the time you don't transfer it. Getting my point? So these 2 points we already know. What about this? This we are going to do with section 46(2). Okay. After we are done with 46(2), this part will be covered there. So question number 1 also done. Okay. Question number 2 is also done. Very good. Come to question number 3. Good question. X converts his capital asset acquired on 10 June 2006 for 60,000 into stock in trade on 10th March 2024. Wait. One capital asset he acquired. This is the date of acquisition of the capital asset. At what price he acquired? 60,000. Can I say this 60,000 is the cost of acquisition of his capital asset? So date of acquisition of capital asset is known and cost of acquisition of the capital asset is also known. Yes or no? Now this is converting. So date of conversion is also known. When it is converted? 10th March 2024. So this is the date of transfer of his capital asset. Date of acquisition of capital asset given, date of transfer meaning date of conversion is the date of transfer is also given. Okay. Now the fair market value was 5,50,000 as on the date of conversion, meaning on 10th March 2024 the fair market value as on the date of conversion was how much? 5,50,000. He subsequently sells the stock in trade, so converted for 6 lakh on June 10, 2024, meaning that the stock in trade is not sold in 23-24 on 10th March. No. 10th March it got converted into stock in trade. Now that stock in trade is being sold in the previous year 24-25 on 10th of June 2024-25. So can I say in the previous year 24-25 two gains will be calculated? PGBP will also be calculated and capital gain will also be calculated, and both will be taxable in the year 24-25 because 24-25 is the year in which the stock in trade is sold. And the capital gain arising on conversion, whatever will be there under section 45(2) will also be taxable in that same year, in the year in which the stock in trade is sold. Stock in trade is sold, so PGBP will also arise. That will also be taxable in the year in which the stock in trade is sold. That's it. But if it is written here that what will be the amount of those capital gain and PGBP income, then we will have to go one step ahead and we'll have to calculate also. Yes or no? So in your question, write down if also compute the amount of taxable business income and capital gains. Now we are going to calculate that also. Okay. So pay attention. Same thing can you see here? What I will do? I will remove the unnecessary things. Okay, sir? Okay, sir? Perfect, sir. I am ready with my format. So, I had a capital asset which I converted into stock in trade, and that stock in trade I am selling, right? When did I acquire the capital asset? Come on, tell me. 10 June 2006. 10 June 2006. Converted into stock in trade on 10th March, no? Which? 10th March 2024. 10th March 2024. And sold as stock in trade on 10 June 2024. 10th June 2024. Okay. I acquired for how much? I acquired for 60,000. As on the date of conversion, what was the fair market value? It was 550. 550 was the fair market value. This is the actual cost of capital asset. This is the fair market value, and on 10 June it was sold for 6 lakhs. Can I say 6 lakh was selling price of my stock in trade? Now these figures will be used to calculate. Done, no? So now tell me, stock in trade is sold for how much? 6 lakhs. So to calculate my PGBP, selling price of stock in trade 6 lakhs. Minus cost of acquisition. What cost? Sorry, minus the cost of stock in trade. What was the cost of my stock in trade? The fair market value as on the date of conversion, which was 5,50,000. I will take this only. So only the gain from 550 to 6 lakh will be taxable under PGBP. That's it. Because that is the gain for the period for which I am holding the asset as stock in trade. Okay. Earlier gain for the period for which I was holding the asset as capital asset cannot be taxed under PGBP. That gain will come right hand side. See 45(2). Yes or no? So here I will reduce 5,50,000. So my PGBP income will be how much? 50,000 taxable. This will be taxable in the year in which the stock in trade is sold, 24-25. Done. Now in that year, the year in which the stock in trade is sold, in that year, the capital gain for capital asset under section 45(2) will also be calculated. The fair market value which is there will be treated as full value of consideration for 45(2). So the same amount 5,50,000 I will take here as what? As my full value of consideration minus transfer expense, no transfer expense. Net consideration will be 5,50,000. Now I will reduce cost or index cost, depends on the period of holding of my capital asset. Can you see the capital asset I started holding on 10th June 2006 and I transferred the capital asset on conversion. So can I say this is my period of holding of my capital asset? And period of holding is more than what? 12 months, 24 months, 36 months, as the case may be. Okay, because what type of capital asset is there, they have not given. Have they given you what type of capital asset it is? So I'll not be able to decide that I have to check 12 months, 24 months or 36 months, whatever it is. It is greater than all the period of holding. And why I'm checking 12, 24, 36, because the transfer, because the conversion is made prior to 23rd July. Conversion means transfer made prior to 23rd July 2024. So 12, 24, 36, all the period of holding can be checked. Okay. Old period of holdings I have to check. Now, if the period of holding is 12, 24 or 36 or less than that, then the asset is short term, no indexation will happen. Hello. But if the period of holding is more than 12, 24, 36, as the case may be, then the transfer is taking place prior to 23rd July, 10th of March. Hello. Now I will have to index the cost also. So what was the cost of my capital asset? 60,000, no? So I will index that 60,000. Hello sir, are you all understanding what is happening? So I will take 60,000 as cost of acquisition of my capital asset into CII of transfer year. In which year the conversion took place? 23-24. March 24 means 23-24. So the year of conversion is the year of transfer. What is the year of transfer? 23-24. What was the CII? 348 if I am not wrong. CII of 23-24 is 348. Okay. Divided by CII of acquisition year. In which year acquisition was made? 6-7. Divide 6-7. What is the CII of 6-7? 122. Now please calculate the index cost. 60,000 into 348 divided by 122 will give me 171,148. 171,148 will be your index cost of acquisition. Fortunately, there is no cost of improvement. If the cost of improvement would have been there, I would have taken that cost of improvement and I would have indexed that also. Hello sir. So reduce this amount out of 5,50,000. You will get 378,852. 378,852. This will also be taxable in the same year in which the stock in trade is sold, 24-25. In the entire question, if you will see, they have not made these calculations. And you were doing. Because it was not asked. Just say when both the incomes will be taxable. That's it. Okay. And when both the incomes are taxable and they're telling you to calculate also, then the calculation will be made like this. Understood everyone? Should I move ahead? Sure. Come to test your knowledge. Test your knowledge. Question number 2. Arav converts his plot of land, meaning a capital asset, which was purchased in July 24. So this is a capital asset which he purchased in July 2004, meaning this is the date of acquisition, and 80,000 was the actual cost of the capital asset. Into stock in trade on 31st March 2024. Can I say 31st March 2024 is date of conversion? Yes sir. The fair market value as on that date was 3 lakhs. So this 3 lakh is the fair market value as on the date of conversion. Stock in trade was sold. Stock in trade was sold for 3,25,000 in the month of January 25. So can I say previous year 24-25 the stock in trade is sold? Yes. So in the previous year 24-25 PGBP will also be calculated. Capital gain will also be calculated. Yes or no? Same to same format which I made. Hello sir. Here. What I will do? I will do the favorite thing which I do always. My format is already ready. Everything will change now. Amounts will change only. What everything will change? Only the amounts are changing. No. Rest everything remaining same only. No. Hello sir. So tell me. Capital asset was plot of land. Plot of land. Okay. Now the capital asset is identified. It is a plot of land. The asset was acquired on July 2004 for 80,000. July 2004 for 80,000. Converted into stock in trade 31st March 2024. As on that day, the fair market value was 3 lakhs. And it was sold on January 25, meaning previous year 24-25. For how much? 3,25,000. That's it. Done. So selling price of stock in trade will be 3,25,000. So selling price of stock in trade was 3,25,000. What was the cost? Fair market value as on the date of conversion 3 lakhs, sir. Sir, what is the PGBP? 25,000, sir. So this same fair market value will now be taken as full value of consideration 3 lakh minus transfer expense, nothing. Net consideration is 3 lakhs. Now, cost of acquisition of the capital asset was, how much? 80,000. So 80,000 will be indexed or will not be indexed. Depends on the period of holding. Please check. Capital asset was plot of land. Acquired in July 2004. And it got converted on 31st March 2024. 20 years period of holding. More than 2 years only, no. More than 24 months only, no. For plot of land, the period of holding should be more than 24 months. Is it more than 24 months? Yes. Plot of land is a long-term asset? Yes. And the conversion, transfer is taking place prior to 23rd July. 31st March 2024 is prior to 23rd July only, no? So the cost will be indexed. And here I will take 348 as the year of transfer. Conversion. Year of conversion is 23-24. That is the year of transfer. Divided by year of acquisition. That was July 2004. 45. What is the CI of 45? 109 or 117? 117, no? 105. 109. 117. 122. 45. What is the CI? 45. I will have to take 45 CI, no? Okay, 113. Oh, 113. Now, index 80,000 into 348 divided by 113 will give you 246,372. 246,372. If I reduce it out of 3 lakh, I will get 53,628. 53,628 will be my capital gain under section 45(2), will be taxable under the head capital gains in the year in which the stock in trade is sold. So the year in which the stock in trade is sold, in that year PGBP will be taxable 25,000 and the capital gain 53,628 will also be taxable. Easy, no? One more question. Come to illustrations. Illustration number 8. Illustration number 8. Wait. Mr. A converts Mr. A converts his capital asset acquired for an amount of 50,000. So capital asset acquired for 50,000 in June 2004. Okay. Into stock in trade in the month of. So converts in the month of November 23. Meaning the conversion is taking place in 23-24. Okay. The fair market value on the date of conversion was 4,50,000. The stock in trade was sold. Stock in trade was sold for an amount of 6,50,000 in the month of September 24. Very easy question. What will be the tax treatment? I will first calculate the PGBP here. PGBP. Selling price of stock in trade. Come on, tell me. 6,50,000. Cost of stock in trade. Fair market value as on the date of conversion. Yes or no? That was 4,50,000. You will not write like this, you will write in the full format. Okay, 2 lakhs. This will be your PGBP income. Now 45(2) capital gains. To calculate the capital gains, do you remember this 450 only will be taken as full value of consideration? So 4,50,000 will be taken as full value of consideration. Minus transfer expense, no transfer expense, sir. No transfer expense. Meaning that 4,50,000 will become your net consideration. Minus cost or index cost depends on the period of holding. So period of holding will start from June 2004 till November 2023. And that period is more than 12, 24, 36 as the case may be. Yes or no? So now the cost will be index. What was the cost? 50,000. So you will take 50,000. Yes sir. Multiplied by CII of transfer year. What is the year of transfer? 23-24. Conversion year is 23-24. Yes or no? Don't take 363 by mistake. The year in which the asset was converted, that year is November 23, means 23-24. So multiplied by 348. Divided by year of acquisition, that is 4,500. You will get 113. Okay. So 50,000 into 348 divided by 113 will give you 153. 982. 982. Okay. No improvements. No improvements, sir. So what will be your capital gain? 296,018. 296,018. Tell me, taxable or not taxable? Taxable in the previous year in which the stock in trade is sold. So what year the stock in trade is sold? September 2024, means previous year 24-25. So this will also be taxed in this year and this will also be taxed in this year. Both will be taxable in the same year. Question number 3. Right? So we will discuss this question first. See, whatever is given in this question now, the only new thing which they have done, they have converted a capital asset into stock in trade. But after converting, they are not keeping that asset same. They are having some additions made to that asset. But the additions are made when it becomes stock in trade. So this entire question which is there, okay, this question number 3. See, what happened in this question, I will explain. It's not solution 2. This is 3. Okay. What are the facts of the question? First we'll understand. There was a land which you acquired in previous year 2004-5. Okay. So in the year 2004-5, you acquired one land. At what cost you had acquired that land? 35 lakhs. 35 lakhs was the cost of the land. And now that land got converted into stock in trade on 21st of March 2024. So 21st March 2024. 21st March 2024. Meaning till previous year 23-24. You were holding that asset as a capital asset. So the date on which it got converted, as on that day, the fair market value was 2 crore 10 lakhs. This is the fair market value as on the date of conversion. Okay. Then after converting the land into stock in trade, you are selling that land as a stock in trade only. But you are not selling it, as a vacant land. You have constructed 15 flats on that land. All the flats are having equal area, dimension and everything. Okay. So the 15 flats which you have converted on that land, this land is being sold along with that flat as a stock in trade. But all the 15 flats you are not selling. You are selling only 10. Meaning the entire land is not getting sold as stock in trade. Only the land which is occupied by those 10 flats, only to that extent the land is getting sold as stock in trade. Yes or no? So when the 15 flats got constructed, the construction of the flats got completed in February 2025, if I am not wrong, Feb 25. Feb 25, the construction got completed. And each flat construction costed 10 lakh rupees. So cost of construction of each flat was 10 lakhs. Okay, out of the 15 flats, 10 flats are sold. Meaning that the 10 flats are sold as your stock in trade. Along with that land which got converted into stock in trade. Yes or no? So selling price of each flat along with the land was 30 lakhs. And 10 flats are sold, meaning that 10 flat along with that land is sold. Entire land is not sold, only the 10 by 15. Only to that extent the land is sold. Because entire land is occupied by 15 flats. If I say on this was your land, okay, no, I'm saying if this was your land, on that 15 flats got converted, 15 flats got constructed, this you acquired as what? This land you acquired as capital asset. Okay. Now you have converted this into stock in trade. So you should have sold it as it is. But what you did, you constructed 15 flats over it. So 1, 2, 3, 4 and 5. Okay, yes, 1, 2, 3, 4 and 5. So what I will do, I will construct 15 flats over it. One, 2, 3, 4 and 5. 15 flats are there? No, now there are more. I have to draw only 2 lines so that there are 15 flats. Okay, no? Now pay attention. How many flats are there? 1, 2, 3, 4, 5. 6, 7, 8, 9, 10, 11, 12, 13, 14 and 15. Okay. How many flats I am selling, guys? All 15. Entire land sold as stock in trade? No. Out of this, I am selling only this much. Selling only this much. So this is sold. And this is still as my stock in trade, still unsold. If you would have sold the entire land, no, all the 15 flats, entire land would have been sold. So the capital gain for entire land I would have charged to tax. And the PGBP of all the 15 flats I would have calculated. Now what I will have to do, in the year, these 10 flats are sold in the month of March, no? March 2025, meaning which year? Previous year, 24-25. So in this year what will happen? 2 statements will be prepared. One is for PGBP. Another one will be for capital gain under section 45(2). Okay, sir. So, what will happen here? Now, come on, tell me. PGBP will be calculated on sale of 10 flats only. 10 flats along with the land occupied. So, what is the selling price? Selling price is 10 flats into 30 lakhs. 30 lakhs each I am selling, no? So, I am getting 3 crores. Now, out of this, I will reduce what? Cost of construction of 10 flats. So, 10 flats got constructed at a cost of rupees 10 lakh each. So, cost of construction is 1 crore. So, am I selling only the flat or flat along with land? Flat along with land. So, there will be some cost for that land which is held as stock in trade and being sold along with 10 flats. Yes or no? So, I will have to now reduce the cost of land. Now, to calculate the cost of land, this land was earlier held by me as a capital asset, converted into stock in trade, and it is being sold as stock in trade. Yes or no? So, what will be the cost of this land? 35 lakhs. The price at which I bought it as a capital asset? No. The date of conversion, as on the date of conversion, whatever was my fair market value, that fair market value will be treated as what? Cost of the stock in trade. Yes or no? So, I will be taking fair market value which was 210 lakhs. But 210 lakhs was the fair market value of the entire land. Am I selling the entire land? No. So, what I will be doing? 210 into 10 upon 15. This will be my cost of land which is getting sold as what? Sold as stock in trade. This is the fair market value of that land as on the date of conversion. I will not take the entire fair market value. I will take only that fair market value which is related to that land which is getting sold as stock in trade. Yes or no? So, it will be 1 crore 40 lakhs. Any other thing to be reduced? No, sir. So, can I say 60 lakhs will be my PGBP income? You all must get this 50 lakhs as what? Your 60 lakhs as your PGBP income. Now, you are supposed to calculate the capital gain. Now, see, if you will take this same amount as full value of consideration over here, that means you are calculating the capital gain only for that land which is getting sold as stock in trade, and that is correct also. You are supposed to calculate that much only. See, the land which is getting sold as stock in trade, the capital gain of that land will only be taxable in this year. But what I will do, I will have to again and again multiply it by 10, divide by 15. So, in spite of doing it again and again, I will do it once only. I will first calculate the capital gain for entire land. Okay. So, to calculate the capital gain of entire land, what will happen? I will have to take the full value of consideration, which is nothing but the fair market value. And fair market value as on the date of conversion will be treated as full value of consideration. That I will be taking as full value of consideration. That fair market value I will be taking as full value of consideration. Okay. So, FVC I will take fair market value as on the date of conversion. That is 2 crore 10. Why I am taking 2 crore 10? Because if I am not taking it 2 crore 10, if I am not taking full, then again and again I will have to do 10 by 15, 10 by 15, 10 by 15. I will do it only once in the end. Okay. Minus what? Transfer expense. Any transfer expense happening? Tell me. See the question. There was no transfer expense. Expenses on conversion. No transfer expense. Net consideration will be 2 crore 10 lakhs. Now, I will reduce cost or index cost. Depends on the period of holding of my capital asset. So, when did I acquire the capital asset? Come on, tell me. See this. When did I acquire the capital asset? 4-5. And when did I transfer? Conversion? Yes or no? So, when the conversion took place? 21st March 2024. So, can I say this is the period for which I am holding the capital asset? So, this is my holding period of capital asset. So, consider this holding period Can you see that the holding period is more than 24 months? So the land becomes your long-term capital asset. And now I know the cost of the land. I have to reduce this only. But will I index it? The answer is yes. I will have to index it also. Because the conversion takes place, transfer takes place prior to 23rd July 2024. So I will have to now index the cost also. What I will be doing? I will be taking index cost of acquisition. In that I will take 35 lakhs into CII of which year? Transfer year. What was my transfer year? Come on, 24-25. Conversion year. Yes or no? Sorry, 23-24. So 23-24 it is 348 divided by acquisition. When I acquired the land, 4-5. So what was the CII 4-5? 113. 113. So 35 lakhs into 348 divided by 113 will give me 1 crore 7 lakh 78. 1 crore 7 lakh 78,761. Everyone getting this? Everyone? Now what I will do? I will divide it by, I will reduce index cost of improvement, but there is no index cost of improvement. I will total now. 2 crore 10 lakhs minus 107,78761 will give me 1 crore 2 lakh 21,239. This is my long-term capital gain, which I have calculated as per the provisions of 45(2). See, if the entire land would have been sold as stock in trade, if all the 15 flats would have been sold, so the entire land is sold as stock in trade, then this capital gain would have been taxed right now only. But is the entire land getting sold, or only the land to the extent of to the extent which is occupied by 10 flats? Only that land is sold, no? So out of this capital gain, only the gain which relates to that land which is occupied by 10 flats, only to that extent the gain will be taxable right now. So I will do one thing. 10 by 15 of this will be taxable right now along with the PGBP income. Yes or no? And the balance 5 by 10 is still occupied by those 5 flats. The land which is still occupied by those 5 flats which are there in stock in trade, which are not yet sold. So whenever these 5 flats will be sold in the future, that time this proportionate capital gain will be taxable in that year. Yes or no? So right now, into 10 divided by 15 will be how much? 68 lakh 14,159. 68 lakh 14,159 will be the capital gain which is taxable. In your previous year, 24-25, the year in which the 10 flats are sold, in that year only this will be taxable. And minus 10221239 will be how much? 34 lakh 0707080. This much will be taxable in the previous year, in which fill in the blanks. Remaining 5 flats will be sold. Taxable in the previous year, in which remaining 5 flats will be sold. Will you remember this? Easy question, but they tried to make it a little bit tricky by involving that calculation of flats, etc. Okay, but no need to worry, the question was this much easy. Okay, now shall I move ahead? 9. Illustration number 9. Singhani and Company, a sole proprietorship, owns 6 machines put in use for business in March 2023. Meaning that last year only 6 machines were bought. Last year, 2022-23, March 2023. That time only the 6 machines were put to use. Meaning that block was already formed in 22-23. And that block was there in the last year also, and that block is this year also. And the opening WDV is given. Okay. The depreciation on these machines is charged at 15%. The opening balance of these machines after providing depreciation for last year was 850. This is the opening WDV of this year. Was closing WDV for last year. Very good. Now, 3 of the old machines were sold on 10th June 2024 for 11 lakhs. A second-hand plant was bought for 850 on 30th November 2024. Determine the claim of depreciation for this assessment year and determine the capital gain liable to tax in this year. These two things cannot come together for a year. If depreciation will come, capital gain will not come. And if capital gain is coming, depreciation will not come. Block ceases to exist. Block does not cease to exist. What we did in the case of depreciable assets. Now, see, depreciable assets forming part of block. Depreciable assets forming part of block in business or profession. Can I say these depreciable assets which are used in my business, which are there in the block, they are my capital asset only? They are your capital asset only. But their entire cost is claimed as a deduction under the head PGBP in the form of what? Depreciation. So we don't bring these assets to capital gain head. Whenever the sale happens, whenever their transfer happens, everything gets adjusted in the block, in the PGBP head only. And the calculation and everything we have already seen. Okay. So what they are trying to tell you, there is one section, section 50. Section 50 under the capital gain head, which says that depreciable assets which are forming part of the block. Okay. On that you are claiming depreciation over there. But there are chances that capital gain or capital loss might also arise. So whatever capital gain or capital loss which will arise on these assets, section 50 says that ignore their period of holding. For these assets, ignore their period of holding. Why? Because the moment they will form part of the block, their identity is gone. No need to identify those assets. And if you are seeing the period of holding for each asset, that means you are trying to give the identity. Ignore their period of holding. The moment they are becoming the part of the block, their identity is gone. Now no need to see their period of holding. And if capital gain or capital loss arises, that will be always short term. Always short term gain or loss will arise. Because if you are not required to see the period of holding, you will not know whether they are long term or not. No. And if capital gain or capital loss arises on transfer of these assets, then that capital gain we want to charge as at normal rates. It is possible only if they are treated as short term. Loss we want to allow from all the gains. The setup of loss we want to allow. Since we are charging at normal rates, so the loss we want to treat as normal. So loss should also be short term. Ignore the period so that it cannot become long term. We want to consider gain or loss arising on their transfer as what? Short term only. And if you are saying that the gain or loss will always be short term, forget about any indexation benefit. No indexation benefit will be granted, because indexation benefit is granted only in the case of calculation of long term capital gain. Yes or no? And for them, the long term capital gain cannot be calculated. The resulting gain or loss will always be short term. There will be no indexation benefit available for these assets. This is what is written in section 50. So whenever you are going to calculate their capital gain or capital loss, whenever you are going to calculate their capital gain or capital loss, it will be calculated as per section 50 only. 50 says ignore the period of each asset, because it becomes a part of the block, and the moment it is put in the block, its identity is lost. Done. Second, the resulting gain or loss, whatever will be arising, will be always treated as short term, and no indexation benefit will be available on their cost. Sure, sir? Everyone? Now, when the gain or loss will arise, that is also given in section 50. Gain or loss will arise if block ceases to exist and value remains in the block, or value does not remain in the block. Block ceases to exist means no assets in the block as on the last day. Yes or no? No assets in the block. No assets in the block, but value is there. That value will be treated as short-term capital loss. No assets in the block and value is also not there. So anything recovered over and above the value will be short-term capital gain. And this was the first case. Second case, if block does not cease to exist. Block does not cease to exist means assets are still there in the block. Yes or no? But now value cannot be there. Value is not there. Then it will be short-term capital gain. Short-term capital gain will arise. Hello? And if there is still value in the block, assets are also there, value is also there, here there will be no capital gain. Here it will be depreciation calculation. This we have already done, if you remember. Now we have to apply this logic, apply these concepts of section 50 in the given question. Block is there, block is not there. If block is not there, meaning all the assets are gone. Value remains, value does not remain, it will be short-term gain, short-term loss. Block is there, value does not remain, then short-term gain. No depreciation can be calculated. Block is there, value is also there. Why are you here? Don't come here. Stay there only. Calculate depreciation and claim the depreciation. Getting my point? So either depreciation will come, and if depreciation is not coming, then only the capital gain or capital loss will come. And capital gain, capital loss will always be short term. No indexation. Hello, sir. Sure. Now let's come to that Singhania question. In the Singhania question, block is given. Block of plant and machinery, depreciable at the rate of 15%. Opening WDV. As on 1st April 2024, opening was 8,50,000. There were 6 machines in the block, opening, and 8,50,000. So 6 machines were there, 8,50,000. Now add what? additions during previous year 24 25. Any additions? Yes. Second hand plant and machinery is bought, no? When it is bought? Before my birthday or after my birthday? Before. Before? After. Date of purchase. Can you see date of purchase? 30th November 2024. Meaning after my birthday. Second hand is there. So what? Second hand is there. So what? Will be added? No. Addition is happening in the block. Less than 180 days. So put to use. For greater than 180 days, greater than equal to 180 days, or put to use for less than 180 days. No. One second hand is bought, no? One second hand. Yes. For how much? 8,50,000. Now total 7 machines are there in the block. Value is 17 lakhs. And during the year I have sold also. Sold means deletions during the previous year 24-25. How many? 3 are sold. 3 old are sold. Meaning new will still be there in the block. Addition will still be there in the block. Yes or no? As at the end of the year. So for how much they are sold? 11 lakhs. Now can you do the totaling? Yes sir. 4 machines still remaining and the value of the block remaining is 6 lakh. Now tell me, is there still assets in the block as at the end? Yes. Value is also there? Yes. Now in this case, no capital gain cannot arise only. So there will be no capital gain under section 5050. Here the depreciation under section 32 will come. Now how will you calculate this depreciation? Out of 6, on some value half rate, on balance value full rate, and additional is also there, then on the actual cost of new plant and machinery calculate additional also. Yes or no? At the rate of 20% and all. Additional is not there. Why not there? Because it is nowhere mentioned that the assessee is manufacturing, power business. Yes or no? If that was the case, we would have taken the additional depreciation also. But additional will not come. And see, even if it was given that the assessee is doing manufacturing business, but he is following 115 BSc, then also the additional would not have come. But the normal would have come. Normal will come on the balance, this balance. But can you see that this machine is still there in the block? This is not sold. And the value which is remaining is less than the value of this asset. So I have told you that whenever something like this happens, on the entire remaining value which is less than the cost of that asset which was purchased in this year and put to use for less than 180 days, on the entire value now will you calculate depreciation at half rate. So I will now calculate on this 6 lakh. Now I will calculate depreciation at what rate? Half rate. Because the 6 lakh is less than the cost of that asset which is purchased during this year and put to use for less than 180 days, and that asset is still there as on the last day of my business. In these 4 assets, that asset is still there. Okay. So into 1/2 will be how much? 45,000. This is your depreciation. first. Second, capital gain under section 5050 nil. How can I calculate capital gain if I am calculating depreciation on the cost? Entire cost is not recovered, no excess recovery is done, no short-term gain. And if some amount is still remaining out of the cost, that represents the cost of the assets which are remaining in the block. On that, the depreciation can be charged. If there was no asset in the block, then the 4,50,000 would have been treated, then the 6 lakh would have been treated as my short-term loss. But assets are remaining, no? Getting my point? So first answer, depreciation will be this much. Second answer, what will be the capital gain for this year? Nil. No capital gain can arise if there is value in the block and there are assets in the block as at the end of the year. On that, depreciation is to be charged, which we have already calculated. Yes or no? Now the same question, if you are selling these three assets, instead of 11 lakh, you are selling it for 21 lakhs. So can I do the same calculations? Yes, same calculation will happen. See, I will again write down this. Again I will write down this. Copy. Paste. Now tell me. I will reduce 21 lakhs from here. Only change is this 21 lakhs. So this will be negative 4 lakhs. Now meaning that excess recovery is happening over and above the cost. Excess recovery of how much? 4 lakhs. Is there any value remaining in the block? No value remaining. Entire 17 lakh is gone. So asset is there in the block, but no value is there. 4 lakh extra coming, sir. In that case, the extra 4 lakh is your short-term capital gain under section 5050. This is short-term capital gain under section 5050. See, Mr. A is a proprietor of Akash Enterprise having 2 units. Akash Enterprises is having 2 units. He transferred on 1st April 2024 his unit 1 by way of slump sale for a total consideration of 25 lakhs. So he has transferred both the units or unit 1 only? Unit 1 on 1st April 2024. Okay. By way of what? Slump sale. And total consideration was 25 lakhs. So friends, 25 lakhs is the total consideration, meaning the lump sum consideration for transferring the entire business. So this will be treated as full value of consideration. But if the fair market value of the assets transferred in the slump sale, if that fair market value is higher than this amount, then this amount cannot be taken as full value of consideration. We'll have to take the fair market value. So they are saying that the fair market value of the capital assets of unit 1 on 1st April 2004 is 30 lakhs. Meaning that now we will have to ignore 25 lakhs and we will have to take 30 lakhs as full value of consideration. Yes or no? So my full value of consideration is 30 lakhs. I will write 30 lakhs full value of consideration. Okay, from this he incurred expenses on this transfer and the amount of expenses incurred was 28,000. So can I say 28,000 is a transfer expense? I will reduce 28,000. So the net consideration which I will be getting will be 29,72,000. 2972 is the net consideration. Okay. Now out of this net consideration, I have to now reduce what? I have to now reduce the cost of acquisition. And what will be the cost of acquisition of this asset? What will be the cost of acquisition of this unit? It's net worth. Okay. So to calculate the net worth, we'll have to first take the assets, all the assets, total assets minus total liabilities, outside liabilities. Okay. So on the liability side, if you see, they are saying that bank loan is 2 lakh rupees. that is outside liability. Trade creditors is also outside liabilities. So I will be taking both these, bank loan also, and I will be taking trade creditors also. But I cannot take the entire amount because the entire amount does not relate to unit 1. Only 70% of the bank loan is related to unit 1. So 70% of 2 lakhs will be 1,40,000. And trade creditors 1,50,000 is there. 20% of that is for unit number 1. So 25% of 1,50,000 will be 37,500. So 37,500 plus 1,40,000 will give me a total liability of 1,77,500. Now I will have to just calculate the total assets. Out of total assets, I will reduce this liabilities. I will be getting what? I will be getting the net worth. Okay, and that will be treated as cost of acquisition, which I will reduce from the net consideration. Okay, no. So to calculate the total asset, will I take the total asset of both the units or only unit 1? Only unit 1. So for unit number 1, which is getting transferred in the transaction of slump sale, what will be the total asset? See, land is not a depreciable asset, so the book value of the land needs to be taken. But if you will see the adjustment number 1 says that revaluation reserve is created by revising upward the value of the land of unit 1. Can you see revaluation reserve of 3 lakhs? So land value of the land is revalued upward, and 3 lakh rupees of revaluation reserve created, that is written on the credit side, written on the liability side. Okay, no. So what I will be doing, I will be reducing this revaluation reserve amount out of the value of the land, because the actual value of the land is not 12 lakh, it is only 9 lakhs. So what I will be doing, this revaluation reserve I will eliminate from my 12 lakhs. So 9 lakh will be the book value. The actual book value of the land is 9 lakh. This 9 lakh only I have to take as the value of land for the purpose of calculating my net worth. Okay. Now, no individual value of any asset is considered in the transfer deed. Thank God. And that is the reason why it is known as slump sale, no? So in the transfer deed, you have not given any individual values to any asset. So, okay. Other assets of unit 1 include patents. Oh my God, they are talking about other assets. 1,50,000 includes patent acquired on 1st July 2022 for rupees 50,000, on which no depreciation has been charged. Meaning that out of this 1,50,000, no, out of this 1,50,000, 50,000 is the value of patent which was acquired in 2022. Do you remember that patent is an intangible asset which is used in business? For that you get depreciation. So patent is a depreciable asset, depreciable intangible asset. If I have acquired this patent in 2022 for the purpose of my unit 1 business, definitely I would have taken the depreciation under the PGBP head for the year 22-23 as well as 23-24. That depreciation is not shown here, meaning that entire 50,000 is recorded in this 1,50,000. So for that 50,000, that 50,000 book value, that 50,000 cost of this patent cannot be taken for calculation of net worth. For every depreciable asset, I will have to take the WDV for income tax purpose. And its WDV for income tax purpose is not 50,000. What I would have done, I would have taken the first year depreciation in 22-23 out of this, and I would have also taken the second year depreciation for 23-24 also. And immediately before the slump sale, immediately before 1st April 2024, what will be the WDV? The WDV will be 50,000 minus the depreciation for these 2 years. That will be the WDV for the income tax purpose, which I have to take for this, for this patent. So 50,000, what I will do, I will reduce the depreciation for the first year, 22-23. So what was the depreciation which I charged in 22-23? In 22-23, I would have charged 25% depreciation, because intangibles under the head PGBP, 25% depreciation rate is there. And that 25% I would have fully charged, because that was the first year of patent, and in the first year of patent, the patent was used for a period of 180 days or more. 1st July it was bought, sir. 1st July to 31st March. If nothing mentioned, that means it was put to use from 1st July itself, before my birthday. Hello. So it was used for how many days? 180 days or more in the first year. So first year depreciation would have been at full rate, and that rate was 25%. So 25% of 50,000 will be 12,500. That was the depreciation for the first year, which I would have claimed out of 50. Minus what? Minus the depreciation for 23-24 also. So what was the depreciation for 23-24? WDV basis 37,500 into 25% will be 9,375. Now, can you tell me what was the value of patents as on 31st March, immediately prior to slump sale? WDV was 28,125. Did you all get this amount? So for patent, no, I'm not supposed to take 50,000 because that was a depreciable asset. On that, I would have claimed the depreciation. After claiming the depreciation, whatever was the WDV for PGBP, I will take this WDV for the net worth calculation. Please remember this, guys. Okay. So this was the only catch in the question. Otherwise, the question was very easy. Now, tell me, what about the balance 1 lakh rupees? Balance 1 lakh out of the other assets will be taken at book value only. Getting my point? Everyone. Now, the value of machinery represents the written down value as per the Income Tax Act. Wow, thank you so much. If they would have given me the book value of machinery and they would have given me the details for calculating depreciation, I would have calculated the WDV of the machinery also for income tax purpose. But what they are saying, that the value which is recorded in the balance sheet is same as that of the WDV, which is there for income tax purpose. So I will be directly taking this 3 lakh rupees value for the machinery. Yes or no? And debtors will be taken at book value. Now, can you calculate the total? 9 lakh plus 3 lakh, it will be 12 lakh. 12 lakh plus 1 lakh, 13 lakh. 13 lakh plus 1 lakh, 14 lakh. 14 lakh plus 28,125. So the value of total assets will be 14,28,125. This is the value of total assets. Now, can I do total assets minus total liabilities? 1428,125 minus 177,500. I will be getting 12,50,625. Can I say that 12,50,625? That is my net worth will be deemed to be the cost of acquisition. I will reduce that. What amount I will get? Minus 29,72,000. I will be getting 17,21,375. 17,21,375. And my dear friends, this is your capital gain. Okay, and this is your long-term capital gain. Why I am calling it long-term capital gain? Because see, unit 1 was set up in the year 2005-06. So from that date, you started holding the unit 1 till the date of slump sale. So the period of holding of the unit 1 is more than 36 months. If it is more than 36 months, unit 1 becomes long-term capital asset and the resulting gain is long-term. You never get any indexation while calculating this capital gain. Even though you transferred prior to 23rd July, there is no indexation benefit available. Yes or no? So why am I calling this long-term capital gain? Because since 2005-06 to 31st March 2024 was the period of holding, and this period of holding was more than 36 months. Hence, the unit 1 was a long-term capital asset and the resulting gain was long-term capital gain. Did you all understand? Everyone? So this was your question, and you won't believe this exactly similar type of question was asked in the exam 2 years ago, and it was for 10 marks. Just imagine these kind of questions they are asking in the exams. Will you be able to solve such questions? See, now what will happen? No, they will just shuffle few amounts. That's it. The entire calculation remains same, no? So they will shuffle some amounts, they will shuffle some details. That's it. You have to be, you have to remember that what we have studied in 50V. And we have to apply those concepts in the same manner, in this same style to get the final answer. Getting my point? No question will be difficult. Please don't keep all such sections in options in your exams. Okay, if these sections are coming, if questions on these sections are framed, no, it is very easy questions and that can give you cash marks in the exams. Sure? Should I move ahead? Friends, ready? Okay, no problem. This is a really good question. Mark this question important. Mark this question important. And we are going to solve this question, okay? Mr. Shiva purchased a house property. House property is purchased. He is purchasing a house property. Purchased a house property on 15 February 1979. Ayyo. For rupees 3,24,000. In addition, he also paid stamp duty at 10% on the stamp duty value of rupees 3,50,000. Wait. That time when he purchased the property, no, at that time he paid the stamp duty also, which is his acquisition cost. Yes or no? So, the actual cost incurred by him to acquire the property was 3,24,000 plus 10% of 3,50,000, which he paid as what? Stamp duty. This is his purchase related expense. Okay, no? So 35,000 plus 3,24,000 will be 3,59,000. So the actual cost of the property to him was 3,59,000. Now tell me, has he acquired the property prior to 1st April 2001? Yes. So his actual cost is this much. Will he get the option to take the fair market value as on 1st April 2001 as cost of acquisition? Yes. But wait, this is an immobile property acquired prior to 1st April 2001. So he will get the option to take the fair market value as on 1st April 2001, but that fair market value should not be more than the stamp duty value as on 1st April 2001. Both the things are given below. See, on 1st April 2001, the fair market value of the house property was 11,85,000 and the stamp duty value was 10,70,000. So you have this option to take 1185, but is this 1185 more than 10,70,000? So you cannot take this fair market value. Your fair market value will be restricted to 10,70,000. So either this fair market value or the actual cost, whichever is higher, can be taken as cost of acquisition. Done? If you crack this, cost of acquisition is gone. Okay. So now what was your cost of acquisition? Tell me. So your cost of acquisition will be 3,59,000 actual cost or the fair market value, which is restricted to the extent of stamp duty value, 10,70,000. Whichever is higher can be taken as cost of acquisition. So tell me, can I take 10,70,000 as my cost? Yes, sir, I can take. But wait, if you have received and forfeited any advance prior to 1st April 2014, even that advance will be adjusted out of this cost. So what happened now? Mr. Shiva in April 2008, can I say prior to 1st April 2014? In April 2008, meaning prior to 1st April 2014, entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and received an amount of rupees 1,11,000 as advance. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. He received the advance of 1,11,000 and he forfeited that advance of 1,11,000. Yes or no? He forfeited that advance. Is it forfeited, received and forfeited prior to 1st April 2014? Yes. So as per section 51, whenever Shiva will transfer the property in future to calculate his capital gain, out of his cost, that advance money received and forfeited will be adjusted. Yes or no? So can I adjust this 1,11,000 from here? Yes, sir. So tell me 10,70,000 minus 1,11,000. 1,11,000, no? 1,11,000. 9,59,000 will be his cost of acquisition. Everyone. Wait, one more advance he has received and forfeited. He again tried to sell the property in May 2015. May 2015 means on or after 1st April 2014. Now whatever advance he will receive and forfeit now, no, will not be adjusted under section 51 out of the cost, because in that year only, in the year 15-16 only, it will be taxed under the head IFRS. So that year what he did, he again entered in an agreement to sell the property to Deep Shikha and received rupees 1,51,000 as advance. However, Miss Deep Shikha did not pay the balance amount. Mr. Shiva forfeited the advance, meaning this 1,51,000, no, under section 51 cannot be adjusted because this was already taxed in the previous year, already taxed under the head IFOS in previous year 15-16, no? So now this cannot be adjusted. For this you will have to give a note that why you have not adjusted that out of the cost. Since it was received on or after 1st April 2014 on in May 2015, that is previous year 15-16, it was already taxed under the head IFOS in 15-16. Hence not to be adjusted under section 15. The same is ignored. Yes or no? Now 959 will be reduced whenever he'll sell the property. So now see what is happening on November 2015. Now these two dates are very important. Huh? November 14 entered into an agreement, sale agreement with Manish for sale of such house for 30,50,000. So sale value, sale agreement value is the sale value, sale consideration, that is 30,50,000. Now, and received an amount of 1,50,000 as advance through account pay check. Wow, wonderful. That out of 30,50,000 of sale consideration, he is already receiving 1,50,000 as sale consideration as advance. And he is receiving that amount out of the sale consideration as on the date of sale agreement or prior to that by prescribed modes. So if you receive the amount of sale consideration by way of prescribed mode or any part of the sale consideration by way of prescribed mode, then the date of sale agreement, as on that date, whatever stamp duty value is there, that can be taken for section 50C. I have told you. So if the date of sale agreement and date of registration, both the dates are not same, usually we take the stamp duty value as on the date of registration. Getting my point? But we ignore that. And we take the stamp duty value as on the date of sale consideration as on the date of sale agreement if the sale consideration or any part thereof is received on or before this date by way of prescribed modes. So this is happening here. On 15th November, you are receiving advance of 150 out of 30,50,000 of sale consideration by way of prescribed mode. So whatever stamp duty which is there on 15th of November, that stamp duty value only will be considered for section 50C. Getting my point? Now the property was registered. Manish paid the balance entire sum and Mr. Shiva transferred the house. On February 20, 2015. Can I say this is dosa? Is this dosa? So this is idli? No. This is DOR, date of registration. That is date of sale agreement. This is date of registration. Both the dates are not same. And now what is happening? The valuation as per stamp duty authority of such house on 15th November was 39 lakhs and on 28th February it was 41. Tell me which one to take. I will take this 39 lakhs and I will ignore this 41 lakhs. So now stamp duty value is higher than the sale consideration. Check. by how much amount? 8,50,000. Difference between the stamp duty value and the sale consideration is 8,50,000, which is more than 10% of sale consideration. 10% of sale consideration will be 3,05,000 only. So if it is more than 3,05,000, then I will have to ignore the sale consideration, and this amount will only be taken as my full value of consideration. Yes or no? Now, when did you sell the property? 15th November 2024 or 20th February 2025? The actual sale happens when the property is registered. Okay, so date of registration we always check for the transfer. So what is the date of transfer? 20th of February. As on that date, the property is transferred. Can I say that date is on or after 23rd July? So now whatever cost of acquisition, cost of improvement will be there. Will it be indexed or without indexation? Without indexation. But wait, the period of holding of the property will start from 15th February 1979 till 20th February 2025. This is the period of holding of the immobile property. Is it more than 24 months? Yes, the property is long term. But still, I have the cost also. But still, I cannot index that cost. Why, sir? Because the property is transferred on or after 23rd July. 20th February 2025 is on or after 23rd. Even if you by mistakenly take 15th of November, no, that is still after 23rd July only. Yes or no? So will you do any indexation? No. So calculation is very simple now. What are you going to do? Simple, sir. Sir, simple. You will take the full value of consideration. Will you take sale consideration, or as per 50C, the amount of stamp duty value will be taken as full value of consideration? Yes or no? So now your presentation will look something like this. Wait, I'll tell you. Wait. So computation of long-term capital gains. For this, I will make working note number 1. Yes or no? Why long-term? I will make working note 1. If you solve the question in this manner, no, you will get full marks. Don't worry about it. Okay. So, full value of consideration. See, instead of making a separate note, no, you can do the workings here also in your main statement, but it will not look good. Okay, no. So what we are going to do for full value of consideration, we'll prepare note 2, because note 1 will be for long term or short term. Yes or no? Less what? Transfer expense. Was there any expense on transfer of the property? 1% brokerage. Yes or no? So I will write down 1% brokerage. And my dear friends, brokerage is always on sale consideration. You are not supposed to take it on the amount of FEC. See, our FEC here will be how much? 39 lakhs. For that, I will do a working note. Okay, no? We have already calculated 39, no? We just have to show it in the working note only. Okay. Now, brokerage will be 1% of 30,50,000. So 30,50,000 into 1% will be 30,500. Now if I reduce this minus 39 lakhs, I will get 38,69,500. 38,69,500. Can I say this is my net consideration? In the exams, no, avoid writing FVC and all. Write the full forms. Okay, no? In the class only we are doing it to save some amount of time. Okay, less. Cost or index cost? Cost of acquisition less cost of improvement. Sir, cost of acquisition, for this also we will prepare a note 3, and cost of improvement is not there, it will be taken as nil, and it was 9,59,000. No guys, Without indexation I am reducing. Why? I will give the note in the note number 2 only, that why we have not indexed it. Okay, so 9,59,000 if I reduce 29,10,500. Everyone getting this long term gain? This is your LTCG under section 112, because this is not STT paid long term gains. STT paid long term gain of equity shares is covered in 112A. Yes or no? STT paid long term gain of equity shares is covered in 112A. Every other long term capital gain covered under section 112. Okay, so now this is long term capital gain under section 112 from a transfer happening on or after 23rd July. On this you are supposed to pay how much tax? 12.5%. Do you remember? Are you an individual? Yes. Are you a resident? Yes. Are you transferring an immobile property? Yes. So whatever tax you will calculate on this gain at the rate of 12.5%, you will have to compare that tax with the long term gain with indexation, and that on that you will apply 20%. Now that 20% is better, than pay that 20% or else pay 12.5% on this, whichever is more beneficial for you. Yes or no? But to do that, we'll have to again recompute the capital gains. But wait, in my computation of total income, no, whatever capital gain I have to show as a part of my total income will be this much only. I don't have to do the indexation while computing the capital gains. Yes or no? Indexation will be done only for the limited purpose of determining the tax liability. That's it. Getting my point, everyone? Now you will see what is going to happen over here. But wait for some time. Okay. So 29,10,500. This is my long term capital gain. What I'll do, I'll first make notes. Then in the end, I will calculate the tax liability. Okay, no? So note number 1. Note number 1 is for period of holding, type of capital asset, and nature of capital gains. Done, sir? Now tell me, capital asset is residential house, no? House property. Capital asset is a house property, which is an immobile property, which was acquired in date of acquisition was 15 February 1979. Since this date I am holding it till the date of transfer, that is 20th of February 2015. Sorry, 2015, not 2025. Okay, so can I say this is my period of holding, which is greater than 24 months? Therefore, capital asset is long-term capital asset and LTCG is computed. Done. This was my note number 1. Now coming to note number 2. Note number 2 very important because FVC will be calculated here. Note number 2. Determination of full value of consideration. So I will first write down stamp duty value. Stamp duty value as on DOSA DOR. Date of sale agreement, date of registration. It is 39 lakhs and this is 41 lakhs. So I will ignore this, but I will take this. Why I am taking this? I have to give the reason. I am taking this why I am taking this. Since 1,50,000 out of the sale consideration is paid on or before date of sale agreement. Actual date, if you want to write, you can write the actual date of registration and date of sale agreement also. Yes or no? Please write it down. Don't leave it. Write it down. What was the date of sale agreement? It was 15th of November, no? So write down 15th of November 2024, and date of registration was 20th of February 2025. Okay. So now, before the date of sale agreement, by way of prescribed modes. Therefore, I will take this. Now see, this amount is greater than sale consideration of 30,50,000 and SDV minus sale consideration. How much? SDV minus sale consideration is 8,50,000, no? Is also greater than 10% of 30,50,000. That is 3,05,000. Now, if these two conditions are fulfilled, therefore, section 50C would apply, and in this case, the full value of consideration is equal to sale consideration of rupees 30,50,000 will now be ignored, and stamp duty value 39 lakhs is treated as full value of consideration. Exactly same manner if you are writing in the exam also, no, still you will get the full marks. Not a single mark will be deducted. Don't worry about this. Okay. Examiner will go mad seeing these kind of working notes. Okay. Now see, 39 lakh. How did we derive that 39 lakh? We got it. Now coming to the cost of acquisition. Cost of acquisition we took how much? 9,59,000, no? So for that also we'll have to do a separate working note. Note 2. Is for cost of acquisition. Actual cost as on 15th February 1979, it was 3,59,000. How did I get this? 3,24,000 plus 10% of 3,50,000. Or FMV as on 1st April 2001, or SDV as on 1st April 2001. What was the fair market value? 11 lakh 15 or it was 85? 1185, no? What is 1185? Yes. It was 11 lakh 85,000 and this was 10 lakh 70,000. This or this, whichever is lower. So I will ignore this and I will take this. Okay. is equal to 10 lakh 70,000. Now 359 or 1070, whichever is higher, 10 lakh 70. Why have you done this? House property acquired prior to 1st April 2001. For these type of house properties, what you do? You determine the cost like this. Okay, no? This is your A, this is your B. A or B, whichever is higher. Done, sir? Therefore, cost of acquisition will be 10,70,000. Now, from this cost of acquisition, no, which was 10,70,000, what you'll do? You will reduce the advance money received and forfeited on first advance money received and forfeited. Tell me the date. April 8 and then May 15, no? April 8 and May 15. This is prior to 1/4/2014 and this is on or after 1/4/2014. Yes or no? How much was that? 1,11,000. This is adjusted under section 51. Huh? Under section 51. So 1,11,000 you will write here, and what you will write here? 1,51,000. Okay. You will cut this like this. Why have you done this, sir? Because already taxed as income under the head IFOS under section 56 to 9. Specific charges there. In previous year 15, 16 and hence not to be adjusted. Under section 51. I have ignored it. Done, sir? Understanding what is happening in your life? Wait, no. First, let us decide the cost of acquisition, Amma. See, in our main calculation, no, cost of improvement, we have taken nil. I forgot to take that cost of improvement. That I'll do. Don't worry. For that note number, no note is supposed to be done. I'll do that calculation here only. I have forgotten this. Okay, here it is not nil. Cost of improvement is there because first floor is also constructed. No, I forgot to read that. Okay. So this gain will not be this much. The gain will be different. But first of all, we are doing the cost of acquisition right now. We have not come to cost of improvement. Okay. So see, now 10,70,000 minus what? Minus 1,11,000. So the final cost of acquisition will be 9,59,000. Got it, sir? Therefore, cost of acquisition finally after adjusting this is 9,59,000. Now, this cost is reduced without indexation since house property transferred on or after 23rd July. Can I say if it is transferred on or after 23rd July 2024? Hence, this 959 is taken over here. Okay, no? See, I did the working for this 959. Cost of improvement I forgot. Now I will consider. Okay. So what was the construction? See, I forgot to read this information. In August 2015, Mr. Shiva constructed the first floor by incurring the cost of 3,90,000. So now we have to consider that also. But will we index it or without indexation? Yes, without indexation. So entire 390 I will reduce here only without any indexation. Done, sir. Now can I say 9 lakh 30, 8 lakh 69,500 minus 9 lakh 59,000 minus 3 lakh 90,000, 25 lakh 20,500. 25 lakh 20,500 will be my final capital gain. Sure, sir? Understood? Now pay attention. Now all the notes and everything are done. Now I will be computing the tax liability. Computation of tax liability under section 112 on LTCG. Now see here, no, A, LTCG without indexation. I will write tax on. Tax on LTCG without indexation at 12.5%. Do I have a LTCG without indexation? Do I have that? Yes, I have. That was 25 lakh 20,500. 25 lakh 20,500 into 12.5%. Into 12.5%. 3,15,063. 25 lakh 20,500 into 12.5% will be 3,15,063. 3,15,063. Everyone getting this tax? So they are telling me to pay this tax. But what I will do? I will tell them that see, I am a resident, individual, house property transferred on or after 23rd July. Hello, but that house property I acquired prior to 23rd July. I will get one option at the time of calculating the tax to pay tax at the rate of 20% on long-term gain with indexation. So now what I will do? I will calculate this tax which I have calculated. Okay, now I will calculate one more tax. LTCG with indexation at the rate of 20%. So for that, now I would require this LTCG amount with indexation into 20%. So now this tax will come. Done, no? Fill in the blanks. Now whichever is lower of A and B is equal to my tax on LTCG under section 112. But to get this, I will have to first calculate the long-term gain with indexation. I have all the amounts. I just have to index it now and properly, correctly. Okay, no? So what I'll do? Come on. Will I take full value of consideration? I'll directly start from net consideration only. Because till net consideration, everything is same only, no? So I'll directly start LTCG with indexation will be net consideration of how much? How much was the net consideration, guys? 38,69,500. So 38,69,500 minus index cost of acquisition I will take 9,59,000 now into transfer year CII 363, and I will divide the CII of which year? 2001 to 100. Getting my point? So 959 into 363 divided by 100, I'll get 34,81,170. 34,81,170, and I will reduce index cost of improvement also 3,90,000 into transfer year CII divided by improvement year was 1516, no? 1516. What is the CII? 254. 254. Calculate 3,90,000 into 363 divided by 254. I'll get 557,362. Sir, big problem, sir. What problem, sir? Sir, instead of gain, it is a loss, sir. How much loss? Tell me. 38,69,500 minus 34,81,170 minus 557,362. You get 169,032. 169,032. This is my loss. Long-term capital loss. If I index, no. Hello. If I index, I would not have got any long-term gain. So my long-term gain would have been how much? Nil. Rather, I would have a loss. Yes or no? Then what would have been my long-term gain? Nil. On that 20% would have been nil. Now tell me, which is the most beneficial thing to do? Pay tax 3,15,000 or pay tax 0? Pay tax 0 only. Yes or no? So this will be my final tax liability, everyone. This is color, pink color. Okay. And how did I get this LTCL? I'll write therefore LTCG with indexation is equal to nil, and if it is nil, guys, I will not pay any tax on nil at the rate of 20. Calculate 20% of nil, no, you will find out it is 20, it is nil only. Okay. Now pay attention. Do you have a loss? Loss of how much? 169,032. Long-term losses will be adjusted against long-term gains only. Yes or no? But this loss cannot be set off also. This cannot be carried forward also. This is just calculated for the purpose of tax liability. You are not supposed to take any set off or carry forward of this loss. Understanding? So they will ask you whether you will take any set off or carry forward of this loss. No. So please write down a star mark for this loss. No set off or carry forward is allowed for such loss. Did you see how smart our government is? How much smart the government is? They did not allow you to take indexation while computing the capital gains. If they would have allowed you, no. So what you would have done, instead of taking the long-term gain in the computation of total income, you would have taken long-term loss in the computation. So you would have allowed the set off from any other long-term gain. And if other long-term gain was not allowed, no, you were eligible to carry forward that for 8 years. Just imagine. So they said no, in the computation only capital gain without indexation. But when you will calculate the tax liability, no, then calculate the tax at the rate of 20% on what? on LTCG with indexation. But you calculated LTCG, it was a loss here. Meaning that there was no long-term gain with indexation. So there was no 20% tax liability. So no tax liability at 20% or tax liability at 12.5%. Which is better? No tax liability. So I will pay this much tax. So now when I'll go to the government and I'll ask the government that government, what about this loss? What to do about this? Government will say forget it. You are not going to get any benefit of this loss. This loss cannot be set off also. This cannot be carried forward because this is not entering in the computation of your total income. This is calculated just at the time of calculating your tax liability. Got it? This is very important. Very important. See, this type of question they can ask you in the exams.